Hi, everybody. I just received an email from a client who sent me this link that you're seeing on my screen of a CTV news article or a news program that was released just yesterday. And it's a really interesting story about an insurance policy that has now been canceled or lapsed and the perspective of the client. So when I see these stories, obviously it's a bit of a black mark on insurance, and the media tends to focus on the negative stories. So let me just uncover what happened here, and I'm going to show an example using today's software, today's rates, and try to mimic the exact same example that this client has experienced. Okay? So this client thinks they bought a guarantee cost life insurance policy. So let me explain. There are two different kinds of cost of insurance when it comes to universal life. There is guarantee cost, so level premiums guaranteed for life. On the screen right now, you can see this is $150,000 it covers, just like the gentleman had on his policy with the exact same insurance company. It's no longer called Transamerica, it's called Ivari. The annual cost is $1,872. That is the cost. It is what it is. And in this case, the minimum premium of $1,872 was made every year. It is what it is. You pay your premium. That's your insurance coverage. It's guaranteed for life. This is what he is alluding to owning. Okay? Let me show you what he actually owned. So there are two different kinds of examples here. So this is what we call an annual renewable term or a yearly renewable term insurance policy. So the difference here, it's exactly the same contract, except the cost structure now has term insurance that goes up in price every single year. Okay? You'll notice the annual charges in year one are $401. Quite a bit different than the $1,800 that the previous example showed. Okay? So if you're a client and you're saying, I plan to put $120 a month away into this policy, let me show you what happens. So $120 a month is the same as $1,440 a year. So the client puts that $1,400 a year in. $400 is eaten up by investment charges. The remainder is now invested. Truly, it's invested. It's invested in the markets. You have options here, mutual fund options within the insurance policy contracts. Here is where we get the challenge or the problem. Back in 1992, which is when this client bought this policy, it wasn't unusual for advisors to use rate of return assumptions of 9%, 10%, 11%. I've seen them. So here's what happens. If you deposit $1,400 and $400 goes to costs, and we can see it goes up every year, and the remainder gets invested, if you're earning 9%, this thing is looking great. In fact, it looks fantastic. You'll see fund value over time never goes down. Well, because the rate of return of 9% greatly offsets the increase of costs. It just makes sense, right? So the problem here is that when I can speak to my experience, when I implement a contract like this, and I don't do it very often, what I use is a guaranteed rate of return. So this is the exact same policy, okay? The only difference here is I changed the assumption from 9.25% to what Ivari is offering as a guarantee. Okay, so this is buying like a GIC, 1.15%. So I know I can get that. What's interesting here is you get the same charges because nothing's changed. The cost is the same. Early on, the fund value is the same because, well, the extra $1,000 is now being invested. The difference is the rate of return assumption. If we're getting 8% less, you can imagine the amount of money that's going to grow later on, which is earmarked to offset the future costs of the policy, which we know we're increasing, is quite a bit different. In fact, this policy after 15 years has $13,000 in investments. And you can see at some point in the future, the cash value starts to reduce. It reduces because the cost of the plan and the interest that we're earning is not sufficient to cover the costs. And you can see the cash value erodes to zero. In fact, in this case, it says year 30. This gentleman on TV, this is what happened. I don't know what rate of return assumptions, I don't know the particulars of his contract, but this is what happened. So, if I look back at the old policy, which shows 9.25%, I just showed you after 15 years there was $13,000 of cash. Well, what he bought, or what he thought he bought, was going to show $27,000 in cash. So the rate of return assumption is the reason why this policy went offside. How do we correct this? It comes down to two people who are responsible. First, the advisor who wrote the case, or whomever is taking over the case. We run what they call in-force illustrations. These are projections. What we do is we can ask the insurance company saying, do we have enough money in here? More than enough money, show me what rate of return we need. A lot of calculations can be done. And those could have been done at any point from year 1 to year 27 for this gentleman. It wasn't done. The second responsibility now is also on the client. You have to know what you bought. If you have an illustration that shows 9.25%, you would have signed the illustration that said these aren't guaranteed. It is your responsibility as a buyer to make sure that you know what you own, and if you're taking risk, like we are here, to understand how to manage that risk. Because at any point in time, we could have changed the investments from something earning 9 to 1, adjusted the deposits to make sure this didn't happen. But when you're 27 years into a policy, and now you're calling foul, I think there's a bit of responsibility on behalf of the client. So I hope now you understand how this happened. I think the media does a great job of reporting. I don't entirely agree with everything that I'm seeing. This is the full story.